Fintechs such as Ally Financial, Wealthfront and Robinhood have been stealing market share from incumbents by offering high-yield savings accounts, above-market average interest, lower required minimum deposits, and no monthly maintenance fees. Ally Financial offers customers a high-yield cash deposit account with 2% annual percentage yield. If a customer deposits $2,500 into the account and lets it mature for 12 months, the estimated interest is $50. Meanwhile, traditional bank Wells Fargo offers Wells Fargo CDs, one of which requires a $2,500 minimum opening deposit and has an APY of only 0.15%, with an estimated return of $3.75 after 12 months. These examples are extreme and US specific, but demonstrate the range in APYs offered, which depends on factors such as market risk, finances, and wider market trends. Market risk must be considered when assigning APYs, meaning banks may lower interest rates to compensate for the cost incurred via unpaid or late loan repayments. Some fintechs, like Wealthfront, do not reinvest, thus have less risk. Traditional banks have exorbitant overheads due to having physical branches and more staff. These costs tend to be passed on to the consumers via a lower interest rate. Furthermore, when the Federal Reserve in the US or the central bank in Europe lowers rates, banks and fintechs lower their rates accordingly. Traditional banks are historically better at predicting these changes. The negative interest rates by the central bank have, for example, led to greater costs to consumers in Germany. In the future, costs could continue to be passed to customers by traditional banks through even lower interest rates.